let's take that theme forward that we were just discussing. We have two bankers now joining us, Deepak Gupta, the joint MD of Kotak Mahindra Bank, and Paresh Sukthankar, the Deputy Managing Director of HDFC Bank. Gentlemen, morning to both of you. We also have our guest editor, Adrian Mowat of JP Morgan, with us to quiz you on several topics. But I'm going to start off with the discussion that we just had with Adrian with regards to the onset of the payment banks and small banks and how disruptive it could eventually be in the longer run for many of the legacy banks. Mr. Gupta, I want to start off with you. In a year's time, there will be 11 payment banks and 8 small banks. So there will be a 45% increase in the number of banks in just 18 months. What could the changes be in market dynamics and how disruptive could it be for legacy banks?
I think the impact of the payment banks will be very different from the impact of the small banks. If you look at the structure, the small banks in terms of width of products can practically do everything which a commercial universal bank can do. So I think the impact of the small banks in specific markets and geographies will be far more significant when you compare them with the conventional universal banks. As far as payment banks are concerned, they are still very specialized product plays. Now, to what extent they can expand their width and get into other areas of banking is still to be seen. But initially, they will really impact only the payments part and customers and businesses related to the payments part, really. So yes, 1 year later, you will see all of these 18 to 20 players. But, to what extent they impact conventional banks, I think is still to be seen, really.
Oh, yes, of course it is to be seen. But before I hand it over to Adrian Mowat, who is our guest editor today and who wants to speak with you all on the matter, let me welcome both of you, Mr. Gupta and Mr. Sukthankar. Mr. Sukthankar, it's true that payment banks cannot give loans, but this is the first time that the Indian banking sector is going to face real competition. I mean, look at the kind of guys who have come. Mahindra's Aditya Birla Group, Reliance Group, Vodafone, people with real technology, proven entrepreneurial talent and loads of cash. Y'all have never seen competition like this. I mean, in any industry, if 4 players become 6 or 7 players, margins will thin. In your case, again, as Sonia said, 50% rise in competition. Won't margins generally thin?
Well, I think it goes back to the question on what impact it would have on what you call legacy banks, because I think to broad brush existing banks as players who would be hurt by what is introduced by the new payment banks assumes that the new players come in with different products or better levels of technology and convenience, which the existing players will not be able to match up to, which I think is a bit of a myth. Certainly the market is large enough to accommodate many more players, especially if the key focus of the newer players is to enable higher levels of inclusion. But I think banks, existing banks or what you might call legacy banks, who have their product range already rolled out in terms of the entire digital space, and there are quite a few of them, I don't think they will be necessarily hurt. Players who don't recognize the changing demographics, the changing needs and the way customers want to actually transact with banks, they might certainly see some erosion in market share.
Paresh, if I could ask a question in a different way, how have you changed your strategy in the last sort of 3 or 4 years to reflect the change in technology?
Well, I think, it's not just the last 3 or 4 years, but I mean, for the entire 20 years that we've been around, we've always seen technology as a key business enabler. And therefore, as a continuing execution on that strategy, we've used technology not just in terms of, improved efficiencies at the back end, but using technology, for instance, in terms of the data warehouse, the analytics to reach out to our customers with more customized offerings. So there's been this entire piece on the use of analytics, which I think has been a huge game changer. We've cut our turnaround times on various products. So it's not just a servicing or an alternative channel usage. It's now a question of reaching out to customers for loan products. We have, for instance, something called a 10-second loan, which obviously feeds on the information we have on our existing customers to not just extend and approve, but actually disburse loans within 10 seconds. On the payment side, again, everything from P2P payments to enabling P2M from apps. So virtually the entire range of banking services that we offer are now available across channels which are the choice of the customer. So we certainly continue to expand our branches, but also have significantly increased our presence on the digital side.
Well, Mr. Sukthankar, I guess always some people will stand out and be able to brave the competition better. But let me pose it this way to you, Mr. Gupta. Think of the coming generation of 20 to 25-year-olds who will have to open bank accounts, staying wherever, outside the 4 metros. Why would they want to open a bank account in a corporation bank or a Lakshmi Vilas or a Karnataka, or even for that matter a Kotak Bank, when they have an Airtel phone with them or when they have a Vodafone with them? Mr. Gupta.
I don't think it is exactly that kind of a problem, really. Even today, if you look at most of banks, really, close to 25-30% of customer acquisition which happens is from the segment which you really are talking about. Again, it depends on what your market segmentation is. What part of the market do you want to cater to? Yeah, you may want to cater to a market segmented around income segments or around generation segments. Yeah, so if you choose to segment your market across generation segments and you want to cater to the Gen Y, really, then you need to invest in technology. And then, mind you, it's not appropriate to say that banks, even the banks which you've named, really have not invested in technology. All of them are really putting in a hell of a lot of money in technology. And like Paresh sort of alluded to, there are 2-3 aspects of technology. Are you investing in technology to improve your efficiency? A lot of banks are actually at this stage putting in a lot of technology inputs into improving efficiency, reducing your cost, increasing, your service capabilities, reducing your time to service customers, all of that. Or are you putting in technology inputs into acquisition of new customers, really? Yeah, so to some extent, for an existing bank, it has to really do all of these on an ongoing basis. It has a limited set of resources, so it distributes them, but it does stay reasonably online. Now, when you try and counter this with an onslaught of technology supported by an onslaught of money, and deep pockets, then probably the equation becomes slightly unequal, and that's what all of us as existing bankers really have to start worrying about, really.
Okay. Well, actually,
I don't think there is any problem on the technology input side.
No, I take your point.
The deep pockets which one has to.
Yes, absolutely, Mr. Gupta. I think Adrian has some questions on that to you, but we have to take a mandatory break now. We'll continue the conversation in a minute. We are back in a jiffy.
Open Exchange, presented by National Stock Exchange. Investor Protection.
Hi, welcome back to the show. We've been in conversation with Adrian Mowat of JP Morgan and a whole host of bankers as well. Very interesting discussion on the onset of payment banks. But before that, the commodity market has just begun. So let's take a look at the opening rates. This is how crude has opened up about 0.5% or so. MCX gold and silver should also come up for you. There's a mild bit of a positive impact that we're seeing in the opening markets. But we'll get to trading ideas in just a bit. Before that, we want to move over to another topic, which is the monetary transmission. Mr. Sukthankar, I want to start off with you before I hand it over to Adrian. The topic of discussion in the studio is why have banks not passed on the rates to the same effect that the RBI has cut rates? What's your own view on this issue, and how much more in terms of rate cuts do you foresee from the banking industry?
Actually, more an industry perspective, Mr. Sukthankar, though we know that you were the guys who first moved on rates.
Sure. No, I think when you ask, why haven't the banks passed on rate cuts, I think that suggests that, the assumption there is that banks have reduced their costs or their deposit rates and then not passed on the benefits of the lower deposit rates to customers on the borrowing side, so through lower lending rates. The reality, of course, is that there is a gap between the cut in policy rates and the actual reduction in deposit rates. And then, of course, the transmission from deposit rates to lending rates through the base rate system works at least once a quarter. So clearly it implies that the reduction in deposit rates so far has not been to the extent that policy rate cuts have been. And this, I'm sure you've heard this before, that clearly on the way up as well, banks had not raised both deposit and lending rates to the same extent, and that as far as the impact on costs are concerned for banks, their funding costs, the policy rate really doesn't impact even 0.5% or 1% of the total banking system liquidity. So the second part of your question, is there still some room for further deposit rate cuts and therefore lending rate cuts? I think there is. Probably, to my mind, somewhere between 25 and maybe even 50 basis points over the next few months. Of course, that is a function of how liquidity remains in the system and how the actual growth in both deposits and loans pans out for the system as a whole.
So if we look at the price of money and maybe move on to RBI policy here, we're sitting in an environment where CPI is positive, although it has come down a lot, and WPI is negative. Presumably for many of your corporate borrowers, WPI is more appropriate. And so we're probably sitting with some of the highest real rates we've seen in India for many, many years. Would you agree with that sort of analysis?
Yeah, sure. I think we have seen now, I guess, more than 10 quarters of negative WPI. But then there is also, and this obviously is linked also to what's happened to the commodity cycle, and therefore a lot of the input costs for a lot of our corporate customers have also come down. But yes, I think rates in terms of real rates, they've certainly been higher than they've been in the past, although they have come down, especially in the market. So apart from bank lending rates, if you see what's happened to commercial paper rates or bond rates, those have certainly come off as well.
Mr. Gupta, how much do you think the non-performing asset cycle is a function of this issue of real rates for the corporate sector, and also real rates discouraging an increase in corporate capex?
I think if you break it up into stock and incremental NPAs, and you first look at the stock of NPAs, I don't think the rate structure has much to impact that position, because most of these stresses were created for reasons beyond just interest rates, or even if they were created because of reasons related to interest rates, the stress really happened a couple of years back, and then all other factors put in has ensured that the stress is sort of reasonably permanent. Now, for some of these to come out of the stress position, and I'm not just talking about NPAs per se, but in general stress per se, you need policy and parameters and factors significantly beyond just interest rates to correct, really. And as and when some of those really fall in place, you will probably see people coming out of them or probably getting deeper into trouble. However, when you look at incremental stress accretion, yes, a downward interest rate cycle helps to some extent, though it creates other problems for corporates related to their cost of production, their margins, their operating leverage, all of that really, which can still continue with the stress. But net, I'd say the relatedness of lowering interest rates to either the stock of stress or incremental stress is really very marginal.
Okay. Well, Mr. Sukthankar, I believe you have to leave. So, final question to you. Are you seeing any improvement in credit offtake at the consumption level? You all are best placed to tell us whether consumers started borrowing more. Is there a consumption-led growth that we can expect?
Yeah, I think we have seen some early signs of higher momentum on the consumption side, and this is probably a little more urban-centric rather than rural. Of course, this is the start of the festive season, so it's still early to try and see whether to figure out whether this was purely seasonal or there is really a more secular uptick in consumption. But we've certainly seen, and I think that's been evident in some of the retail loan products. So I think some of the cyclical factors have played out, And for half a minute, if I was to just jump back to the NPA issue, because that again relates to partly cyclical and partly, as Deepak said, customer specific issues. I think the cyclical elements there on not just on growth but even on the NPL piece might have played out, but the borrower specific or customer specific issues, I think that's a mixed bag, where some maybe things are improving and some with fractured balance sheets is probably a protracted issue.
Okay, just a follow-up question to that before we let you go, Mrs. Sukthankar. Some of your peers like Axis Bank have seen a lot of stressed asset formation problems in this quarter gone by. HDFC Bank doesn't have that issue just yet. But for the industry as a whole, do you think that we're not out of the woods as far as stressed assets are concerned, and it could perhaps get worse from here?
Like I said, I think those concerns or pressures which were coming because of just the lower growth rates and the business cycle, I think those are less of an issue. For instance, if you look at a product like commercial vehicles and so on, which goes through a typical business cycle, those kinds of concerns I think are probably, we've seen the worst. But when it comes to borrower-specific issues, where there were issues of, say, projects getting stuck or mines, being revoked, I think depending on what's happened in those particular cases, maybe things have bottomed out. But there are several other borrowers where their balance sheets are still under severe strain, and even if there is a slight uptick in their operating performance, it's clearly not adequate to pull them out of where they are in terms of the debt servicing needs that they have. So I would say things are not necessarily getting much better for a certain segment of borrowers. But overall, I think perhaps it's going to be a mixed bag.
Right, we're running out of time, and so are you, I believe, Mr. Sukthankar, Mr. Gupta. Thank you very much for joining us in this banking discussion.